Before making any decision to invest your cash, it's critically important that you understand the variety of investment products that are available to you and how they operate. Knowing what investment products are available and understanding their features will allow you to create an investment portfolio that is more tailored to your financial needs. However, and this especially applies to those who are beginners when it comes to investing, getting a good understanding of the variety of investment products that are available is oftentimes easier said than done. How's it going, everyone? My name is Dan. You can call me Malone, and today we are going to be taking a look at 5 different types of investment vehicles that are commonplace in today's financial markets. We're going to be discussing what each investment type is, how it operates, and some of the characteristics attributable to the investment itself. At the end of the video, you'll hopefully have a better understanding of each investment type and whether or not you can see that investment being a part of your own personal portfolio. But before we begin, as always, if I could ask you to please drop a like on the video, it really does help me out a lot as YouTube pushes the video to more people based on the number of likes that the video gets. And if you are new around here, please do consider hitting that red subscribe button. It would be great to have you back again in the future on other videos. So without further ado, let's get started. So the first investment type I want to discuss is bonds. Bonds are oftentimes referred to as fixed interest or fixed income securities and are effectively a form of borrowing by the issuer of the bond. Bonds may be issued by governments, public authorities, companies, and other entities, but the important thing to remember is that they are a form of debt financing. Just like how you might take out a loan to buy a new car, a company may issue bonds in order to raise money to expand its operations. These bonds are then securitized and are made available for the likes of me and you to purchase on the market. So why exactly would you want to purchase a bond? Well, by purchasing a bond, you are effectively becoming a lender to the issuing party. Because remember, bonds are a form of debt from the perspective of the issuer. And as a reward for being a lender of cash, you will typically receive regular interest payments known as a coupon on the face value of the bond. Therefore, you ultimately purchase a bond to gain access to regular income in the form of interest payments. These interest payments will continue until the bond reaches what is known as the maturity date, at which point the bond will be repaid. In this example, you can see that we have invested €1,000 in the bonds of a particular company. The bonds currently have an interest rate or coupon of 5%, and we're going to say hypothetically that the maturity date is 5 years from now. So as we can see, the investment income calculator on Vanguard's website is telling us that we can expect $50 or €50 per annum on this investment. Therefore, if we hold the bond up until maturity, we can likely expect $250 or €250 worth of income on this investment. As I mentioned, at the maturity date, we expect to receive our initial investment back, so we can likely expect our €1,000 investment to be repaid to us once this investment matures. So from a €1,000 or $1,000 investment in a bond, we are walking away after 5 years with €1,250, being a €250 profit. What's important to note is that the prices of bonds traded on the market are invariably linked to prevailing interest rates, which are effectively the minimum interest rates that lenders or investors would expect to receive on their initial investment. If prevailing interest rates go up, the prices of bonds will go down, and if prevailing interest rates go down, the prices of bonds will go up. If we take our previous bond example, let's say that the prevailing interest rate rose to 6%. If you think about it logically, that face value of the bond of €1,000 is likely going to fall because investors will be able to obtain a higher interest rate in the form of a 6% yield elsewhere, whereas our bond has a 5% interest rate attached to it. So therefore, the value of our bond overall is going to go down. Over long-term periods, bonds are seen to be more secure and less volatile than stocks, but they're likely to yield lower returns on investments. Speaking of which, the next investment type I want to discuss is stocks. So a stock, otherwise known as an equity, represents an ownership interest in a company. What this means is that when you go ahead and buy stocks on the stock market in a particular company, you have an ownership interest in the net assets and earnings of that company. Just like how bonds represented debt financing, stocks represent equity financing. Companies issue shares in order to raise money to expand their operations and grow the business. It's just that they're actually obtaining that financing in a different way by issuing shares instead of issuing bonds. The primary difference is that by issuing shares, the company doesn't have any legal obligation to pay out a payment associated with those shares, unlike bonds, which typically have interest payments, otherwise known as the coupon, which we previously discussed discussed. However, some companies may make a payment associated with the ownership in the share, and this is known as a dividend. So how exactly do stocks operate, and how do investors make money on stocks over time? So the two main ways in which investors make money on stocks over time is by both capital appreciation and dividends. When you buy a stock on the stock market, you're effectively paying the price that at that point in time the market deems to be the value of one share in that company. Then as you hold that particular share over time, that perceived value of one share in the company has the potential to go up as well as down. So the increases associated with the value of shares over time is known as capital appreciation. However, what's really important to remember is that the increases in value associated with the shares that you hold is not real money into your account until you actually sell the share. So in theory, you could hold lots of shares which have increased significantly in value over time, but none of these increases in value will translate into real gains and real money earned until you actually sell the shares. The other aspect of how money is made on stocks, as I previously mentioned, is dividends. Dividends are more akin to bonds because they represent regular payments of income on a quarterly, half-yearly or yearly basis. But as I mentioned, the company in which you purchase a share in most cases is not legally obliged to pay out a dividend as a result of you owning a share in the company. So that's how bonds and shares differ when it comes to regular income payments. With bonds, you're guaranteed that fixed regular interest payment associated with the coupon on the bond, but with shares, you're not necessarily guaranteed to be paid that dividend payment. It is at the discretion of the company. And that's why bonds are generally seen to be a less volatile and more secure investment than stocks, because if you own a stock that doesn't pay a dividend, you're more or less relying on the market alone to determine your gains on that stock by way of capital appreciation. However, there's always the chance that the market will go against you and the value of your investments will fall when it comes to the stocks that you hold, and if that company is not paying a dividend, you're ultimately going to be at a loss on your investment. Generally speaking, some of the most commonly referred to attributes of stocks is a higher return on investment over time at the cost of higher volatility. The graph on the screen now represents the level of volatility present in the market on any given day with respect to swings in stock prices. As you can see, at the height of the economic downturn in 2008, there was a lot of volatility in stock prices in the market. And again, in March of this year, we saw some significant volatility in the stock market in light of recent events. So what's important to remember when it comes to stocks is that yes, you do have the potential to earn that higher return over the long term, but you are also taking on higher levels of volatility in the stock market. The next type of investment I want to discuss are exchange traded funds, otherwise known as ETFs. An ETF is an investment vehicle which allows you to buy a collection of securities at one convenient price. It operates similar enough to a stock in the sense that it's traded on a stock exchange, can increase or decrease in value over time, and has the ability to pay dividends. However, where the two differ is that while a stock gives you an interest in one particular company, an ETF has the potential to give you an interest in many companies. An ETF can contain any number of investments such as bonds, stocks, commodities, or a mixture of these. And they're a popular investment choice because they offer easy access to a diverse portfolio of investments without having to actually go out and buy each individual investment which is contained within the ETF. One of the most popular ETFs is the Vanguard S&P 500 UCITS ETF, or VUSA. The term UCITS just means undertakings for collective investments in transferable securities, and really just means that this particular ETF meets the EU-wide regulations for collective investment funds, which ETFs qualify as. As of making this video, one share in this particular ETF will cost you €50.84, but will bag you an interest in the top 500 publicly traded companies in the United States, weighted by market capitalization. So just by taking a quick look at the actual market cap breakdown of the S&P 500, we can actually see what percentage of your initial investment is going to be attributed to each company within the index. So of the €56.84 that you paid for the Vanguard S&P 500 ETF, we can see that 6.82% of that investment relates to Apple, 5.71% relates to Microsoft, 2.26% relates to Facebook, and so on and so forth. And the weighting of each company included within the index is included within the weight column the entire way down the page. And as we can see, there really is an extensive amount of companies included within the index tracked by the ETF, so you really are guaranteeing yourself that level of nice diversification on your investments. But as I mentioned, the ETF investment product isn't just concerned with stocks and index funds. There's also bond ETFs, industry-specific ETFs, and commodity ETFs. Pretty much no matter what investment type you can think of, there's probably an ETF for it. ETFs are fantastic for giving investors access to many different types of investment opportunities across a wide number of industries, and also offer some of the best value when it comes to the fees and expenses that they charge on their product offering, which are typically very low. Furthermore, they are great for the individual investor for managing investment risk because inherently they are typically well diversified. So the next investment type I want to discuss is cryptocurrency. Cryptocurrency is a digital currency which is secured by cryptography. Cryptography involves mathematical techniques of encrypting and decrypting data in order to keep it private when stored or transmitted electronically. Unlike traditional currencies, cryptocurrencies cannot be counterfeited. They are unbanked in the sense that they don't have a traditional financial infrastructure, and they are generally seen to be frictionless in the sense that they don't rely on any intermediaries to trade. The value associated with any given cryptocurrency is still quite speculative in nature because they are non-productive assets. Effectively, what a non-productive asset is in the context of cryptocurrencies means that the asset itself has no means of producing income for the holder of the cryptocurrency. When you buy a cryptocurrency, you're buying it on the basis that you believe you can sell it to another buyer down the line at a higher price. But the cryptocurrency itself is not going to change in this intervening period. It will always be how it currently is. However, stocks on the other hand are productive assets because they represent an interest in a living, breathing corporate entity which can produce both income and capital gains for their owners. And this is why cryptocurrencies are so susceptible to large value swings, because their price is heavily influenced by both supply and demand as well as the economic environment around us. The success story of this year in respect to cryptocurrencies was Chainlink, which started 2020 at €1.58 per token. This rose to highs of €16.75 per token in August, a gain of 940% in 8 months. However, this then fell to lows of €6.58 in September, reflecting a 1-month decline of nearly 61%. The world of cryptocurrencies is still very much esoteric, and investors need to be aware of the significant volatility, both positive and negative, that exists within this investment type. The last investment type I want to discuss today is cash. Cash as an asset class isn't in any way flashy or glamorous, but it's more so just important that you understand that cash is an asset class which is considered in the context of both personal investment portfolios and also pensions. When we talk about cash as an investment class, we're typically referring to cash on deposit in a bank account or money market investments. Cash on deposit in a bank account usually takes the form of either cash in a current account or cash in a savings account. And the general rule of thumb is that cash on deposit in a savings account in a bank is going to yield more interest over the long term, and that's because cash in a current account is used for frequent transactions on a day-to-day basis, whereas cash held in a savings account in a bank is generally meant to be held for a longer period of time in order to allow that interest income to accrue to your account. However, as I've previously mentioned in other videos on the channel, the return that cash investments are offering at the moment is very, very low. So if you are thinking of investing, it is worthwhile keeping in mind that the return on cash investments is not going to be the most optimal investment for you at this current point in time, especially if you have a higher tolerance for risk. And just for completeness purposes, to explain what a money market fund is, a money market fund is effectively a fund which invests in highly liquid and short-term investments. These investments typically include cash, cash equivalents, and high-quality short-term debt instruments. Generally speaking, money market funds exist to offer investors high levels of liquidity coupled with low levels of risk, but also the trade-off to that is a low level of return. So hopefully here at the end of the video you have improved your knowledge of the 5 investment vehicles that we have discussed today. Having a good and solid understanding of the prospective investment vehicles that you're considering for your own personal investments is critically important, because if you don't fully understand what it is you're getting yourself into, you won't be able to manage your expectations with respect to your returns. And remember, the information in this video is for educational and entertainment purposes only. If you are unsure about any prospective investment decision, I would recommend going ahead and contacting a professional financial advisor. So if you did enjoy the video today, please do let me know in the comments below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.